Today, we're going to tackle one of the absolute biggest challenges in trading. How in the world do you know when to get out? We're going to dive into the tools that promise to see the future and find out what really happens when you use them. I mean, this is it, right? You're riding a profitable wave, everything is going great, but you've always got that nagging voice in the back of your head. When do I cash out? If you get out too early, you leave a ton of money on the table. But if you wait too long, you watch all those profits just evaporate. So is there some kind of secret signal?
Well, for a lot of traders, the supposed answer to that million-dollar question is a technical tool called an oscillator. It's designed to be your personal early warning system. But what exactly is it?
At its very core, the idea is incredibly simple. Seriously, forget about trading for just a second. An oscillator is just something that swings back and forth between two extremes. You know, like a pendulum on a clock or a wave in the ocean. It just goes from one side to the other.
This is a perfect way to visualize it. You see the wave moving between 2 points, but honestly, the on-off switch is the best analogy for trading. An oscillator is supposed to tell you when it's time to buy, you flip the switch on, and when it's time to sell, you flip it right back off. Simple as that.
So here's the key idea. Oscillators work on this premise that before a big trend can turn around and go the other way, it has to slow down first. Think about it like a huge freight train pulling into a station. It doesn't just stop on a dime, right? It has to lose steam, it has to slow down. Oscillators try to measure that exact loss of momentum.
And you know what? Sometimes this works so perfectly, it honestly feels like magic. Let's take a look at a real case where these tools lined up to give what looked like a flawless, can't-miss signal.
Okay, so check this out. We've got 3 really popular oscillators, the stochastic, the parabolic SAR, and the RSI, and they're all looking at the same currency pair. And then, boom! Look at what happens right at the end of December. All 3 of them flash a buy signal at almost the exact same time. I mean, it's a picture-perfect textbook setup.
And what happened if you took that trade? A massive 400 pip gain. Wow. Now, when you see a result like that, it is so easy to start believing you've found the holy grail of trading, right? It feels absolutely foolproof. But is it?
Well, this is where things start to get complicated. What happens when the magic trick doesn't work and the signals start fighting each other?
Okay, now look at this mess. Right in the middle of February, the parabolic SAR is screaming sell, sell, sell. But at the exact same moment, the stochastic is confidently flashing buy. And the RSI? Well, the RSI is just sitting on the sidelines, totally undecided. It's absolute chaos.
And this is the reality for so many traders. One tool tells you to go up, another tells you to go down, and a third one says, I don't know, maybe. So who do you listen to? Do you just flip a coin and hope for the best? It's a moment of complete and utter confusion.
The reason these signals start fighting isn't just random chance. It's actually baked into their very design. And once you understand why, you can start using them the right way.
So why the big disagreement? Well, it's because they're not even measuring the same thing. The stochastic, it looks at the price range, the high versus the low, which makes it really sensitive to short-term volatility. The RSI, on the other hand, only cares about the closing price. And the parabolic SAR, it uses its own completely unique formula. It's like having 3 mechanics look at your car engine, and they all give you a totally different diagnosis.
And this gets to the fundamental flaw, the shaky foundation they're all built on. Each one of these tools works on a rigid assumption that if the price does X, the result will always be Y. They're programmed to see a pattern and expect the same outcome every single time.
And, as the source material for this so beautifully puts it, that idea is complete hogwash. The market isn't a simple math problem. It's a dynamic, chaotic, human-driven environment. The idea that some formula can predict what it's going to do with 100% accuracy, well, it's just not based in reality.
So, if these tools are flawed, are they useless? Should we just get rid of them? No, not at all. But we have to totally reframe how we think about them. And that leads us to the real golden rule of using any indicator.
The fantasy is believing you can just turn on an indicator and have it print money for you. It's a really tempting idea, but at the end of the day, they are just tools. They are not crystal balls.
And this is the real takeaway. Your brain, your strategy, and your discipline, they are infinitely more powerful than any indicator on a chart. Think of these oscillators as confirmation tools, not as prediction machines. When the signals are all messy and confused, like on that second chart, the answer isn't to take a wild guess. The strongest, most profitable move you can make is to do nothing. Just wait for clarity.
I want to leave you with this incredibly powerful quote from veteran trader Peter Brandt. See, ultimately, trading isn't about finding the perfect signal. It's all about managing risk. Tools like oscillators can help confirm a decision, yeah, but they can also mislead you. The only signal that truly matters is your answer to this one question. Can I afford to be wrong on this? That is the one signal you have to pay attention to.